G'day everyone. My name's Tim McGowan and welcome to this property-specific webinar. Today we are discussing property prices around the country, a subject everyone loves. Now, if you talk to agents, property at the moment is literally being listed and sold on the same day. There's panic to get on the train before it leaves the station, and there is a real fear of missing out. Now, of course, property prices are being fueled by cheap money, with the RBA now reviewing banks' lending criteria as it tries to put a lid on property speculation. Did you know the average Sydney house price is now 14 times higher than the average full-time salary of $90,000? In comparison, wages in Australia have grown by just 1.7% in 2021 versus a 20% rise in property prices. And it's not just Sydney. Around the country, property prices are expected to complete the year with close to 20% rises across almost every state. Now, everyone loves to talk property. So today you'll hear from the listed real estate group, the agency, ASX code AU1, followed by industry expert Tim Lawless, who'll give us some further property trends and insights. And then we'll introduce some agents from around the country as we discuss what they're seeing in their specific property markets. And at the end, we'll have a panel. We'll have everyone online and you'll be free to ask questions. So type your questions in the green box provided. First up, we have the agency. We have with us the CEO, Geoff Lucas. Now, Geoff was previously the COO and CEO of McGrath and was also previously the CEO of listed financial services group Credit Corp. Geoff, over to you. Thanks for your time.
Thank you very much, Tim, and thanks everybody for taking the time to attend today. Look, it's our pleasure to meet with you today to present what was released to the ASX this morning, which was our first quarter results for FY22. If we could just move to slide 3, please. Before I start, I think it's important just to really present to you the market in which our business operates. And you've probably all heard Tim and other commentators and economists talking about the sheer size of the Australian real estate market. And it's 9.1 trillion as at the 30th of September, as you can see on the slide there. The point here for us, however, is the relativity in that market to other types of financial assets or asset classes. Australian superannuation, you can see about a third. Also the entire ASX, about a third of the Australian residential real estate sector, and commercial real estate somewhere around a ninth or a tenth of the size of our industry. Importantly to investors and stakeholders in the company, the box at the bottom there talks about the total addressable market that we are participating in. And to calculate that, we take the gross value of transactions throughout the year. So you'll see there in the picture, there was 600,000 transactions for a total of $437 billion. If you apply a commission rate, about 1.3%, the markets that we operate in, it's substantially higher than that. But if you took a conservative average of 1.3%, you've got a total addressable market for gross commission commissions to be generated of $5.68 billion. To put that in perspective, we had quite a strong year last financial year. We were up from some 49 million GCI to 81 million. So that really puts into perspective the market in which we're playing and the addressable market that we are chasing. If we could just move to slide 7. The agency operates a different business model, and you'll see throughout this presentation, I'll talk about our rate of growth, and that's because it is different. And we think we've structured this business for the time that the industry is moving through. We're a contemporary business model. The vast majority of the Australian industry is represented by franchise groups and franchisees. We have 2 significant differences to those businesses. The first is we contract directly with our agents. We have some 334 agents currently across the country. Now, we contract directly with them. This compares to, say, a franchise business like a Ray White or perhaps an LJ Hooker or a Rain and Horn, where they have between the company or the brand and the transaction another layer, which is a franchise principle. and they take a leakage of income from that transaction value, which they're entitled to because they've invested the entrepreneurship, the capital, etc., the employment, but there's a leakage. We take that layer out and contract directly, and by doing that, we're able to pay our agents a slightly higher split whilst still retaining a profitable share of the transaction. That's attractive to agents. It's increasingly attractive in a time when people are starting to question the value of the legacy franchise systems. Now, that's not to say there's not a place for franchise businesses. There certainly is. But we see a thematic moving toward this type of direct model. The second way that we differentiate significantly is the style of offices that we have. We don't believe that you need the old style residential real estate agency on a street corner with a very expensive fit out and attendant leases, etc., and capital costs. We prefer to operate large hubs in our metropolitan centres, and you might have 2 or 3, or perhaps in a city like Melbourne or Sydney, perhaps up to 4 of those hubs. These are places where our agents can come and congregate and collaborate and talk about their respective businesses and share information, but increasingly the business is done digitally and in communities in which those agents serve physically. And so they're not in those offices all of the time. The franchisee businesses find it difficult to actually pivot and change quickly to that model because they've got legacy arrangements of long-term franchise agreements, leases and capital contributions to their fit-outs, etc. So we think that gives us a competitive advantage, and we actually think it's a sustainable competitive advantage. That's the backdrop of our business. Now to the salient points of today's announcement. We are pleased to bring to the market the results that we've had in the first quarter. Our gross commission income, pleasingly, was a 47.5% increase on the same quarter of last year. That translates into a revenue of $16 million, which is an 18% uplift on the first quarter of the previous financial year. One of the great measures that we use, because it takes away price impact, is the actual number of transactions, sales, if you like. And we've had a 44.6% growth in the number of sales in the last rolling 12 months to the previous rolling 12 months. We're very pleased with that rate of growth, and that comes on the back of productivity improvements. The market has been up strongly as well, and I'll talk to the market in a moment, but also in terms of the number of agents that we've been successful in recruiting into our business. We've put the business into a strong financial position, which we spoke about at the end of the financial year, but we've continued to strengthen that position. And you will have seen by our 4C that we've now got cash or cash equivalents of $6.8 million. Debt remains as it was at the year end, as does the valuation of our rent roll. So moving on to slide 8, that's just a very quick graphic depiction of the steady rates of growth across all of the major metrics that we measure. GCI, as I discussed before, the number of sales, the number of listings, and also the gross value of sales in our business. And you'll see there's steady growth, and the vast majority of those metrics are now at fresh highs. So moving to slide 11. I mentioned before about the market. We've had growth in transaction numbers of 44.6% year on year on a rolling basis to September. Now that compares favourably against the market. A lot of businesses are out there talking about how strongly they're performing, etc. But what we shouldn't forget is that the market in terms of number of transactions has been up very, very strongly over the last 12 months. Now that's contrary to some of the media commentary that you may hear, because everybody's talking about no stock contributing to very high prices. In fact, the rate of transactions or the number of transactions that have occurred are at 5-year highs, and that's because of the absorption of stock that was previously listed. But pleasingly, and we do measure ourselves against the market, we continue to outperform the market growth. Thank you. We've continued to grow the number of agents, and I spoke about this before. We believe we've structured our business as a contemporary business to suit the phase of evolution that the industry is going through at the moment. And so therefore, it's an attractive business to more and more agents. Whilst you've seen relatively steady growth in our agent numbers, up to and including June in 21, you'll see the last column there. We've skipped from 308 agents to 334 during the first quarter. And that's about an 8% increase just in the first quarter. That's pleasing because it vindicates the model that we've got. It's an attractive model, and we're starting to receive inquiries from increasing number of agents, which increases the market share that we've got in our respective communities. Just on the distribution of those agents, at the end of the quarter, 158 over in WA, 22 in Victoria, 149 in New South Wales, and 9 in Queensland. So clearly the growth markets for us, and we're starting to see increasing rates of success for both Queensland and Victoria. And we'll continue to focus very heavily on growing our agent base. Thank you. This is a repeat of the chart that we put out at the end of the year, but it's an important chart to understand where the business came from in terms of its balance sheet and where we're headed to. So the chart I'm referring to is on the top right-hand side. And you'll see a very rapid reduction in the amount of debt, which is the top or orange line, down to 8.35 million, and an escalating rate of growth in our EBITDA, which is 4.57 million at the end of the financial year. Now, we haven't disclosed that today. We are putting out our quarterly numbers, but we intend to put our EBITDA and profit, obviously, at the half year and full year, rather than coming and doing that at each quarter. But we think we're giving you a fairly good indication as to the trajectory of the business by the key metrics that we're disclosing today. Thank you. What are we seeing at the moment and looking forward? We are continuing to see strong growth, and the industry is seeing strong growth. We've got a very strong pipeline of listings. What we've seen in the past period of 2 to 4 weeks is a significant outperformance of the same period. For example, the first 2 weeks of October this year compares by more than 50% of an increase over the previous 2-week period in the prior October. That's a very, very significant increase, and we're starting to see more and more numbers of homes coming to market in the run-up between now and Christmas. Obviously, our intention is to increase our market share. Our market share currently sits at about circa 1%, depending on how you measure that, whether it's on number of transactions or value. And our aspiration, obviously, is to grow that significantly. Thank you. We have spoken about this before, and we've been intentional in structuring a very, very strong and experienced management team. We've positioned ourselves for growth. And because of that growth that we're expecting nationally, we've made sure that we've armed ourselves with people with great expertise for a long period of time in the sector. And that's reflected by the management team and the board there. Thank you. This last slide just shows, again, the corporate structure of the business. We've got a market capitalisation of just $23 million at the moment, and that's really represented, moreover, by just simply the assets that we've got, which include our cash, our rent roll, and also the value of our mortgage book. You'll see the structure of our shareholding register there on the left. Pleasingly, we've got 16% of the stock held by agents, 8% directors and management, 30% is Peter's Investments, who also hold a convertible note as the major shareholder. And then we've got the balance of 40% held by other shareholders. In terms of forward view, we are encouraged by what we see in terms of volume. One of the lead indicators that we look at is CMAs. These are comparative market analyses, and they're requested of CoreLogic by agents when they go in to speak to potential vendors. So what that says to us is when those levels rise, we can expect to see an increase in the number of homes coming to market. What we've seen there is in the most recent 7-day period up until October the 12th, we saw a 38.5% increase in CMAs over the prior 7-day period the previous year. So we think that that's a very, very strong indicator of what is still to come to market between now and Christmas, and indeed into the new year. We have given a slight forecast. I think it might differ slightly to what Tim may speak about. We think we see growth in terms of national prices between about 4 and 6%. That's a big drop on where we've been, but the market has gone fairly hard, and we're expecting a continuation of that through to the end of this year. But we're a little bit more sanguine in terms of what we expect in price growth, and certainly the market moving to more of an equilibrium, which we think is a very healthy state for the market looking forward. Thank you very much, Tim.
Thanks, Tim. Thanks, Geoff. Next up, we have a keynote presentation by Tim Lawless, who's the Research Director of CoreLogic. Tim is recognised as a leading authority on residential property and regularly provides expert commentary on real estate market conditions, demographic trends and economic factors. Tim, over to you. Thank you.
Tim, thank you. And congratulations, Geoff, on such a solid Q1 result for you and your team. Very strong conditions out there, but it's great to see your outperforming system, so to speak. My job today, guys, is to give you a quick update on what we're seeing in the housing market more broadly. So I will be skipping a few slides here and there, guys. The deck is a little bit larger than what I have time for today. But if you are interested in seeing the whole deck in its entirety, no doubt Tim McGowan at Share Cafe or ping me on LinkedIn or something like that. We're more than happy to share the full deck with you. And for Colin, my trusty slide advancer, apologies in advance, I might ask you to forward a couple at a time. But let's go forward to page 3, and we'll start with a bit of a view on what we're seeing in terms of the trends in housing values. And unless you've been under a rock somewhere, you'll know that the Australian housing market has been on a very strong growth run. We can see over the past 12 months nationally, housing values have just broken the 20% growth mark. So up 20.3% in national terms. The last time we saw growth this strong was way back in 1989. Very different conditions back then, of course. The real growth drivers back then was more around financial deregulation, loosening credit policies. We saw a lot of deflection of demand towards housing, away from the share market after a fairly spectacular crash. But of course, a few years after that spectacular growth run back in the late 80s, we of course saw Australia move through a very brief recession, which didn't impact the housing market all that much. You can see on the graph there, we saw a very brief period where values did contract. But going forward, I would tend to agree with what Geoff says. We should expect that over, say, the next calendar year, we won't be seeing growth conditions as strong as what they are at the moment. And I'll touch on some of those reasons in just a moment. If we jump on the next slide, Colin, we can already start to see the rate of growth or momentum in the housing market is already starting to lose some oomph. For want of a better word, clearly the market is losing some steam for a whole bunch of different reasons. Look at markets like Sydney or Melbourne. Well, Sydney, you can see the rate of growth has slipped from a rolling quarterly change. It was getting up around the sort of 10% mark. That's now slipped down to a little bit less than 6% quarter-on-quarter growth. Still an extreme rate of growth. Don't get me wrong, this is still growth that's well above average, but it is starting to lose some momentum. You can see that in Melbourne, you can see it in Perth and Darwin most visibly, but other markets like, say, Brisbane and Adelaide have seen the market sort of move into more of a leveling of the growth rates. Canberra still very strong. You can see that the market there is still accelerating, even though lockdowns are still in place. But I think some of the reasons for this loss of momentum simply come back to not necessarily lockdowns, but more specifically, things like worsening housing affordability. There's less stimulus available, particularly housing-related incentives to get into the marketplace. And we're starting to see some more supply coming into the marketplace now as well, although overall advertised supplies still remain remarkably low compared to what we normally expect this time of the year. But we are starting to see the number of new listings ramping up. Partly that's seasonal, it's spring, but also we are seeing markets like Melbourne and Sydney seeing a lot of pent-up supply now being unleashed into the marketplace as those markets emerge from fairly strict restrictions. So we jump on the next page, we can start to see some of the challenges around housing affordability. The typical house price in Sydney now is about $1.3 million. Melbourne's approaching the $1 million mark for houses. But the unit sector, we haven't seen values rising quite as quickly there. In fact, nationally, the rate of growth is about half of what it was or what it has been for houses. So we are probably going to start to see some demand being deflected back away from detached housing, away from lower density options towards that medium to high density sector, simply because that's where people's budgets are going to be able to give them entry point to the housing market. We know that APRA has just recently started to tighten up some of their credit policies as well. We don't think that's going to have a material impact on the marketplace, but it probably does, just provide a warning or maybe a shot over the bow that lenders are going to become a little bit more cautious around things like how much debt borrowers have in relativity to their incomes, how much deposit they have. Generally, lenders will be insisting on a 20% deposit, for example, and what's the overall focus or perspective from policymakers like the Reserve Bank and APRA around overall household debt levels and their exposure to the eventual rise in interest rates, which of course isn't going to be imminent, but we should expect probably around mid-2023 or 2024, there is going to be a lift in interest rates down the track, which of course is probably going to be the cue that the housing market will start to move through a down phase. Let's jump on the next slide, and we can see that there has been quite a difference in the demographic trends across Australia. Obviously, we've seen overseas migration stall. I'm not focusing on that at the moment. I'm focusing more on the internal migration trends, where we've seen a lot more people moving away from the capitals into the regional markets. In addition to that, a lot more people who have already been in the regions deciding not to move to the capitals. And that's really amplified this regional growth trend that we're seeing that has seen a lot of the regional markets around the country outperform their capital city counterparts. So we jump on the next slide, you can see that trend really broadly. You can see that the capital cities have underperformed compared to the regions, particularly through the second half of last year. That gap has kind of normalized a little bit more throughout this the first half of this year. But you can see on the next slide, there's a real underlying theme here. Look at the best performing markets around the country. This is the top 30 sub-regions or SA4 sub-regions around the country based on the annual rate of growth. There's a real sub-theme here around lifestyle markets and coastal markets, not necessarily regional areas, but also your outer fringe metro areas like, say, the central coast of Sydney and the northern beaches, two of the strongest markets in the country. You've got the Mornington Peninsula on the outer fringe of Melbourne's coastal market there as well, another very strong performer. You've got markets like the Sunshine Coast and Gold Coast and the Richmond Tweed, which includes Byron, all up there in that top 10 performing markets. There really does seem to be a renewed sea change and tree change trend that's driving a lot of these coastal markets. No doubt part of that is this newfound popularity of flexible working arrangements and working from home. There seems to be a renewed trend towards housing options or housing preferences moving towards lower density options as well, which goes hand in hand with a lot of these regional markets as well. But as I mentioned a bit earlier on, you'd have to expect with pricing becoming a little bit out of a lot of people's, at least the mainstream budgets, there probably will have to be a bit of a pullback in some of these trends we're seeing, either a deflection of demand towards medium to higher density styles of housing, or looking more towards non-coastal markets where price points tend to be lower than what they are along the coastline. Okay, let's jump forward another slide or another two slides, and we'll move on from values and start looking at volumes. This was one of the key points that Geoff was making in his deck, that we have seen transactional activity really lifting, which may be a bit of a surprise considering we've seen Australia's population growth move into negative territory due to the fact that overseas migration has stalled. But we're really seeing a lot of demand now being unlocked because of very low interest rates, because of more household savings, which gives them a better leg up into their deposit to get into the marketplace, because a lot of government incentives that have now generally expired as well. You can see the annual rate of growth. We've now moved beyond 600,000 sales over the 12 months ending September. That's the most sales we've seen since about 2004. But of course, if you adjust that for the number of dwellings in the country, which is a little bit over 11 million, the actual rate of turnover is still only just a little bit above average at the moment. And this is one of the, I guess, the helpful explainers as to why we have seen housing market demand so strong at a time when population growth is quite low. It really comes back to this period of very low levels of activity prior to the middle of 2019. There's been a lot of pent-up demand building up in the Australian housing market that's simply been unlocked when mortgage rates came down as low as what they are, and when finance policies were relaxed back in the middle of 2019. That's when APRA originally reduced their serviceability buffer, which they've recently just reinstated, being a 3% above the going mortgage rate. So there's been a few reasons why we've seen housing demand coming back, but of course, we are starting to see some signs that demand might be becoming a little bit more exhausted, partly due to this bring forward of demand, but also due to affordability becoming a little bit more challenging in the marketplace. We jump forward a slide and we'll start to look at some of the more recent trends in volumes. So the previous slide was looking at annual volumes. Now we're looking at the monthly number of sales. Okay, you can see the graph on the left. There is a pretty clear trend that we are starting to see sales activity slipping a little bit. And there's a bit of noise in this as well due to the lockdowns. If we jump onto the next page, I provided a bit of a view on what happens across the three largest capital cities over the year to date. Remember, the year to date is the really dark blue trend line, and the other trend lines are the previous calendar years. So there's a really stark example here being Melbourne, for example, where you can see the number of sales has been consistently trending lower since around April earlier this year. And of course, we know that Melbourne's been through a lot more lockdowns. The rules around, say, things like property inspections have been much tighter than what they have been in Sydney as well, which helps to explain why we've seen this ongoing downwards trend in Melbourne. Whereas in Sydney, yep, there is an ongoing downwards trend, but that's reversed coming into September. Part of that reversal was Sydney starting to move out of lockdown, but also starting to see more listings coming into the marketplace in line with spring. Then go to Brisbane and Perth down the bottom there. Obviously, those two cities haven't had as much exposure to COVID, hasn't been as many lockdowns or anywhere near. There's been a few spot lockdowns, but you can see transactional activity has been much more stable. You can probably also throw into that the fact that both of those cities are much more affordable than, say, Sydney or Melbourne as well. So they haven't seen that additional brakes being put in the marketplace because fewer people can afford to buy a home in those very expensive markets as well. So if you jump forward a page, and it's starting to look at who's actually buying in the marketplace. The best way to get a view on that is starting to look at the mortgage-related activity. And you can start to see that there's a real changing of the guards here. You can see, for example, first home buyers that were previously leading the rate of mortgage growth have now moved into negative territory. 3 months ending August, the value of first home buyer loan commitments was down about 13%. Whereas investors, you can see the value of lending to investors over the 3 months ending August was up about 12%. Sure, it's lost a bit of steam. We've seen lending slowing across each of the broad segments of the marketplace, but absolutely investors are now the key segment of the marketplace to watch. They're growing the fastest. Investors are probably motivated by the ongoing high rate of capital gain, the fact that interest rates are so low. Even though yields have been compressed, we have seen a widening gap between mortgage rates and gross rental yields as well, particularly outside of Sydney and Melbourne. We know Sydney and Melbourne rental yields are very low. Sydney's at about 2.5% gross, Melbourne's at about 2.8%. So probably not as much incentive there for investors if you are looking for, say, positive cash flow opportunities. But we know most other capital cities are seeing gross rental yields generally around the high 3s, low 4% mark, which I think is going to be very attractive to investors, especially when you add to that the annual returns we're seeing in terms of capital gain. Go to the next slide, and you can start to see the differences between each of the major states in terms of the credit trends. Remember, credit trends give you a fairly timely view on, well, of course, how many people are getting a loan or the value of loans being committed to, but it also gives you a feel for the types of buyers that are becoming more or less active in the marketplace. The WA trend, for example, really helps to explain why we've seen this real slowdown in the rate of growth across Perth. Sure, it's a marketplace where the fundamentals are still very strong, where listing numbers are still very low, but we have seen this leading indicator that there's been less finance being issued across WA after a fairly sharp start to the growth cycle. You can see the WA trend was much stronger early in the piece than most other markets, but overall, the overall level of quarterly finance growth is now down 4%, mostly dragged lower by a real sharp reduction in first home buyer activity. Whereas if you go to somewhere like Queensland, we're still seeing finance growth of about 0.6% quarter on quarter. New South Wales is still up about 5.5% quarter on quarter. So some very different conditions there when you start looking at the finance side of things. If we jump to the next slide, we can start to get a bit of a view on the supply side. So we've just covered up on demand. Demand's very strong. We're seeing the number of home sales, the highest it's been since 2004. But on the supply side, it's very different. Probably the first graph here on the right-hand side, which tracks the total number of listings in the market, gives you a bit of a feel for how tight overall advertised supply is. So we're seeing the total number of listings at the beginning of October was about 27% below the 5-year average, about 23% lower than what it was a year ago. But that's despite the fact that we're seeing this really strong upwards trend in the number of new listings being added to the market, which you can see in the graph on the left. So total, or the number of new listings being added to the market is about 3% above average. But remember, the rate of sale is tracking about 25% above average as well, which means there's still a lot of downwards pressure, or there's still a lot of pressure on the overall number of sales. Back to Geoff again, his point around a really rapid rate of absorption is really exemplified by these two graphs. So a higher level than normal of new listings being added to the market, but overall stock levels remain really low simply because buyer demand is continuing to outweigh supply. If we jump on the next page, we can start to see those trends across each of the capital cities, at least in the number of new listings being added to the market. So look at somewhere like Melbourne, another really good example of here, the impact of lockdowns on the amount of supply being added to the market. You can see how volatile that new listings trend is across Melbourne. As soon as we saw the restrictions around one-on-one property inspections loosened across Melbourne, remember prior to September 18th, if you wanted to go and buy a property in Melbourne, you couldn't actually physically inspect it. It was a real dampener of the marketplace. Vendors didn't want to list, buyers didn't want to buy, simply because, if you're spending hundreds of thousands of dollars, you want to actually check out the property physically. So as soon as we saw those rules relaxed after September 18th, it was almost like a switch got turned on, and you can see that the boom in new listings has just rocketed. This data is up to October 3rd, so there's been a few more weeks of data since then, and we've seen real estate agent activity not slowing down either. So chances are we will continue to see Sydney and Melbourne listings really ramping up, taking advantage of the pent-up supply that's been built up in the spring season. Whereas go to markets like Brisbane or Adelaide, and you can see that they've been pretty sublime in terms of the number of new listings being added to the market. We're not really seeing a spring phenomenon in those markets just yet. Perth's been pretty strong, so is Darwin. We're seeing listings above average in both of those markets, which is probably, again, another factor that's contributing to a little bit of dampening in the rate of growth. There is a little bit more supply in those marketplaces to choose from, which obviously provides more choice for buyers and reduces the level of urgency that they're feeling in the marketplace. So let's just go forward a couple of slides now, Colin. Let's skip over that one, and we'll go to some of the selling conditions now. Most people will be tracking clearance rates. We know clearance rates are highly relevant for Sydney and Melbourne, because that's where the two cities where auctions are really popular. And you can see that clearance rates have really bounced back. Again, this data is up to the end of September, We've seen a few more weeks of data now, and we've seen Melbourne's clearance rate has now bounced back into the mid to high 80% range. Sydney's actually continued back up into the mid 80% range as well. Very strong indicators that buyers and sellers are still, vendors still hold a lot of the leverage. And you can see that in the private treaty metrics as well on the next page. Homes are still selling really quickly, averaging about 29 days. And the vendor discounting rates on the next page are also still indicating that vendors aren't really budging on their asking prices very much at all. All of these indicators imply it's still very much a seller's market. But my guess is as we move towards the end of the year and coming into next year, we probably will see a bit of a normalization in the number of listings that are in the marketplace, maybe a little bit of a further dampening in the amount of demand in the market. If I'm right about that, it probably means that we'll see this ongoing reduction in the amount of urgency that buyers are feeling, which then will obviously help to take away some of this heat that we're seeing in the marketplace as well. Let's jump on really quickly to the rental market. Just go forward a couple of slides, Colin, and you can see what's happening in the rental markets are up about 9% over the past 12 months. Generally, we're seeing stronger conditions in houses than units. We can see that on the next page. House rents are rising at about double the pace of unit rents, but units are starting to catch up really quickly now. A lot of this weakness we're seeing in the unit sector was attributable simply to the fact that inner Melbourne and inner Sydney have been really hard hit by less tenancy demand, partly due to less foreign students, but also, as people were working from home, there was less demand to be living in the inner city. But we've really seen a bounce back across a lot of those inner city precincts, probably because rents, for example, in Melbourne CBD, they're down about 25%. So a lot of renters are really taking advantage of that renewed level of rental affordability that's come into those inner city precincts. Let's skip forward a couple of slides, Colin. I know I've only got around about 5 minutes left, so I might just go to the headwinds and tailwinds slide, which is on page 29. I'll skip over some of these new construction slides. Keep on going, 2 more, please. And we'll finish up on some of the headwinds and tailwinds we're seeing in the marketplace. So I'll start with some of the headwinds, some of the challenges that are likely to be facing the market going forward. Well, we already know that affordability is becoming much more of a challenge. And it's really important when we talk about affordability, I'm not talking about your ability to service a loan. That's actually pretty easy for most people. If you look at, say, mortgage serviceability ratios, they're around historic lows. When I'm talking about affordability, I'm generally talking about your ability to get into the market, raise a deposit, fund your transactional costs, and get a loan. So we know that's becoming harder, partly because incomes are hardly moving. Household incomes are rising at about 1.5% per annum at the moment. And we know that housing values are rising at a bit more than 20% per annum. So clearly there's a massive disconnect there. It's becoming much harder for those people who don't own a home to raise a deposit. We've also started to see credit conditions tightening. Okay, so we've seen APRA have lifted their serviceability buffers from a 2.5% assessment buffer, which simply means if you're applying for an interest rate where the mortgage is, say, 2%, the lender previously would be assessing you at your ability to repay your interest rates at 4.5%. So 2.5 percentage points above the going rate. APRA's now said we'll be assessing you at a minimum of 3 percentage points above the going mortgage rate. So you'd now be assessed at a 5% mortgage rate. So that probably reduces mortgage or lending capacity by around about 5% for the average borrower. Probably implies if you're an existing investor with existing debt, remember that buffer is applied not just to the loan you're applying for, but the entirety of your debt portfolio. So it probably implies that existing or more heavily indebted borrowers or households will probably find it a bit harder to get a loan. But for borrowers who weren't looking to borrow the maximum amounts, they won't really be affected by this credit tightening. But definitely keep an eye on this. We could see credit policies being tightened further from here, especially if we see a further lift in loans being issued on, say, high debt to income ratios. We know in the June quarter, that was about 22% of new mortgage originations, up from 16% a year prior. And we know that household debt was also rising. In fact, owner-occupier housing debt relative to incomes was at record highs in the June quarter. They're likely to push a little bit higher. And if APRA feels a bit less comfortable, I should say, as well as the RBA and the broader Council of Financial Regulators, there could be a further tightening in credit policies, maybe firm limits on debt to income ratios or firm limits on LVRs. And that will probably have a more material slowing effect on the market. Potentially, we could see interest rates lifting a bit earlier as well. The chances of that are looking relatively dim in the near term. But the RBA is sticking to their mantra. They don't expect rates or the cash rate to lift until 2024, the earliest. Most private sector economists are probably not quite as conservative as that. They're thinking maybe early to mid 2023 is when the RBA will see their inflation target met, which implies labour markets would have tightened up a lot more. We would have seen wages growth coming through by, say, mid 2023. But I think it's pretty certain that if we do start to see interest rates rising, that'll be a firm cue that the housing market will probably move into its down phase. Okay, every single growth phase or a significant growth phase or sustained growth phase we've seen across Australian housing markets has been followed by some level of a correction. So inevitably, that's something we need to be planning for. And then finally, we've obviously got migration remaining low, the risk of COVID, evolving as well. But the tailwinds, of course, we've got very low mortgage rates are set to stay for an extended period of time. Even though we haven't seen the cash rate move since October last year, we've seen this ongoing downwards trend in mortgage rates. They're probably at the bottom now, I would expect, but we shouldn't expect that there's going to be a lift in variable rates. At least we are seeing a little bit of upwards pressure on fixed term rates, of course, now that the term funding facilities expired. We should expect that the economy is going to start to bounce back. We're seeing our biggest states coming out of lockdowns, restrictions are easing. Probably won't be as rapid a bounce back in the economy as what we saw through previous exits of extended lockdowns, but no doubt we'll see labour markets tightening up, wages starting to improve, economic activity lifting more broadly, as long as we, obviously hit there's vaccination targets to be met and all this sort of stuff. And then there's improving economic conditions generally improve household sentiment as well. And we know that there's a really strong correlation between high sentiment and housing market activity as well. So to wrap that up, my view, a little bit different from Geoff, as he mentioned. I'm probably maybe a little bit more aggressive on where I think the market might be a year from now. I wouldn't be surprised if we finished the 2022 calendar year somewhere between, say, 5 and 10% growth nationally. But I think there will be a lot of variability in that result. So I'm looking at markets like Southeast Queensland, Adelaide, Perth is probably the better performing markets, whereas really expensive markets like Sydney and Melbourne, where potentially we mightn't see as much investment activity because the yield profile is so low, and there is quite a bit of exposure to overseas migration in those cities as well, maybe not quite as strong either. So my guess is those three markets, SEQ, Perth and Adelaide, could be outperforming, as well as I think this ongoing sea change and tree change probably still has some legs, but particularly in those markets that offer up commutability as well as livability and to some extent affordability as well. So on that note, Tim, I'll pass it back to you. Thanks again for inviting me along to have a chat, and looking forward to the questions that come through.
Great, thanks, Tim. Thanks for your time. Now we're going to get a panel together. We're going to bring on some of the agents from around the country. So we have David Price, who's the General Manager of Queensland. We have Matt Lahood, who is the CEO of the agency, and he can talk about the New South Wales market. We have Peter Kakos, who's General Manager of Victoria, Stuart Cox, who's the General Manager of Western Australia, and we'll also welcome back Geoff Lucas onto the panel. Now, gentlemen, I might start in Queensland with you, David. This is a new market for the agency. You've grown your team considerably and you've achieved some big auction results. It's also a market that's been very different to the rest of the country, given there has been no lockdown in Queensland, or no significant lockdown. Given what you've heard from CoreLogic, can you give us some insights into the Queensland market?
Thanks, Tim. Good morning, everybody. I very much agree with everything Tim had to say, and it's been very interesting because in the last quarter, we've seen a lot more listings come on, and I actually thought the prices would come off, or certainly not come off, but not continue at the rate they've continued to drive at. Now, we're still seeing exceptional prices up here, and it doesn't look like stopping. And because of the amount of stock that's come on that has increased, I really thought it would have. So I'm quite surprised by that, which is interesting. Now, I've been to Cairns to Coolangatta in the last month, and the unit market on the Gold Coast is really being driven by owner-occupiers, especially from Sydney. And Sydney's really driving our whole market in Queensland. And this is the same thing that happened in 2007. In 2007, the Sydney buyers saw huge value because the Brisbane market was underpriced in their eyes. So they're buying the properties and sight unseen. And Saturday we had 2 auctions, one to a owner-occupier, which was a record for the suburb, which again really surprised me on the price because that would have been worth 900,000, say 18 months ago. We sold off nearly 1.5 million. The owner-occupiers from Sydney, I'll go back to the Gold Coast for a moment. The unit market there has really changed because the developers always used to buy a build for investors. Now they're doing half floors and 1 floor per floor, and they're selling out within 48 hours, the entire building. Now we're talking about buildings with 30 and 40 floors and 80 units selling out in 2 days at full list price, which is absolutely, I just can't believe it. And I can't believe it will continue. If you look at the Brisbane market, it's just transitional like normal. You've got people upgrading and downgrading, and then you've got the Sydney market that's driving the Brisbane market so much. I haven't seen, as I said, this many Sydney buyers since 2007, and the prices, they're just pushing it up and up and up. Again, we had an auction 2 weeks before, Sydney buyer bought it straight into an investment, and that's what's happening. In 2007, they didn't actually move up here, and they haven't moved up here, the Sydney buyers. They just simply buy them and land bank them. Sunshine Coast, a lot of people from Brisbane have moved up there. Sydney again is driving the Sunshine Coast. And then you look at the regional markets, say like Rockhampton, where they're seeing not a lot of growth in price, but certainly transactional is moving a lot quicker. The days on market have really come down, and they're finding it a lot easier to sell the houses. Previously, say a Rockhampton would be quite difficult with days on market, but again, it's being driven by Sydney people. So it's very, very cyclical, I suppose, as to what we've seen previously. Then they just land bank them, wait for them to make money again, and then sell them on in years to come. So that's what we're really seeing. But I think the prices do have to stop. I agree completely with Tim. It's just a matter of when.
Thanks for that. David. Now, Stuart, over to WA. WA is always a different beast as a market as well. Given the CoreLogic data you presented, can you give us your insights?
Yeah, Western Australia, if we were a sporting team, I'd say we are consistently growing. And we've got a couple of isolated pockets that are overachieving. It's been consistently increasing now for probably 9 months. Our prices are up of 18% year on year. Every sub-region of Western Australia has gone up. The lowest increase is 13%, the highest increase is 22%. Our monthly sales are up to about 4,500 now, which is 45% up on the 5-year rolling average. But interestingly, sales across the whole of Western Australia for the last 12 months for about 63,000 properties, of which 75% of that, or just under 50,000, was in the metro area. But 13,000 of that was in the regions of Western Australia, which is actually an increase of 63%. So our regions have bounced back really, really strongly. They were hit really hard through the recession, through the mining industry. That's bounced back now, and the regions are overperforming. The saga with the listings is the same probably nationally. Our advertised stock is actually down 25% on the 5-year rolling average. New listings are actually up 18%. But because they are being absorbed so quickly, the stock that's on the market is reduced. So that's slowed down a little bit in the last sort of 2 to 3 months. But it's slowed down mainly due to the fact that the absorption rate was incredibly high in the previous quarter, and it's probably reached now a more normal basis. But to put it into context for our particular business, in the last quarter, we actually sold 96% of the properties that we put on the market. So, you know, that conversion rate from a listing to sell ratio is incredibly high. Our rental market is also very, very interesting at the moment. Our rent is up around about 25% year on year. Our listings are actually significantly down. Our current stock is about 40% below our 5-year rolling average. And that's putting massive pressure on the rental market. The regionals are even worse. The regionals are down about 56% available stock on their 5-year average, which is putting huge pressure on the regions for the rental market. In any sporting team, you've got some overperformers. We've got some really, really strong performers going on in, especially the lifestyle stuff. I agree with Tim. The coastal suburbs of Perth have seen some massive growth. So, for example, City Beach, a couple of k's from the city, right on the water. Previous year, around about 70 properties transacted. So far this year, already 135, 31% increase in price. It's put the median price in that particular suburb up to over $2 million. So, you know, 30% increase on a $2 million property. The owners that are sitting in that particular suburb, you know, are loving what's going on at the moment. Cottesloe is another one, median price of 2.4 mil, increase from 80 sales in the previous year to already 143 this year. So that coastal strip has been, you know, very, very strong, very, very positive. But touching on the regions, South Hedland, Port Hedland and Boulder, you know, 3 areas that are very mining driven. Port Hedland, a growth in rental values of 65% year on year. Port Hedland 40% and Boulder 35%. And that's just proof that the mining industry coming back in, bringing people into these areas, and the demand for rent has absolutely spiked. One unsung hero in the Western Australian market, very uncommented suburb of Bixton, which not many people would know of, faces the city on the river. Incredibly 33% year on year increase in value, over 100 sales, jumped from 60 to over 100, median price now sitting at 1.2. So for the first time in a long, long time in Western Australia, we've got a number of suburbs where the median price is sitting over $1 million, and we've seen that double-digit growth, which we've not seen for years. We expect the market to carry on just because the new stock that is coming on has got such strong demand that, you know, we're just not getting a chance to actually advertise these properties long term. And most of our agents have got big databases of pre-qualified buyers ready to just take up stock. So we think Western Australia market is encouraging. Personally, I can't understand why you wouldn't buy in Western Australia. You know, but all in all, things are good. It's good.
Thanks, Stuart. And before we go to Victoria, just remember to type some questions in. We've got questions coming through, so don't be afraid to ask some further questions. Now, Peter, over to you. You're the General Manager in Victoria. Very different market given the extended lockdown. Can you give us some colour on what's going on down there?
Some reality, you think? I'm just so jealous of Queensland and WA. It's quite amazing. If we're using that sporting analogy, Stu, would be sort of a bit injury prone down here. We're just coming back from injury. So, but I've got to say that, you know, Victoria and believe what you're hearing, what happens down here, because it's all true. But gee, I said it once before, it's so resilient down here, and the market, just how it responds is just quite phenomenal. Now, if we have a look at when we came out of lockdown, going back sort of a few weeks, and we were able to show homes again, physically take a person through a home. And as Tim said earlier, it was getting rather difficult down here to sell a home without anyone seeing it. I know it happens up in those northern areas, but down here, you know, well and truly very important that they see it before they buy it. So there was a slight lag that came out of lockdown, and it was probably a little bit concerning at first. But what it was, I think, people were just taking that cautious approach, and it was slowly but surely. And what we've found over the past sort of 3 to 4 weeks is momentum is once again growing. People are getting a lot more confidence back in the market, and that's on both sides with buyers and sellers. So the vendors were delaying coming to market, and a lot of that delay was due to the fact that they couldn't actually get tradespeople in to present the home up to how they wanted to see it. So that caused a bit of a delay. And what we've now seen is a heightened number of properties that are hitting the market, which is become things more buoyant again. Buyers are certainly coming back in great numbers as well. So we're finding some real momentum growing on both sides. One of the interesting things is, and we're obviously very fascinated with auction and clearance down here in Melbourne, what we've found is a lot of people are becoming a little bit less risk adverse. And what I mean by that is people are more so inclined to look at offers before. Buyers are coming forward without waiting to auction and putting their best foot forward. And sellers alike are saying, you know what, if we get our number, we're out of here. We don't need to wait that 3 or 4 week period for auction. So there is an increased number of properties, and you'll see that in the clearance rates. But if you break down those clearance rates even more, you'll actually see that there is a huge chunk that's actually selling before it actually gets to the day. So that there is showing great confidence and people just wanting to get on with it. You know, let's just move on and get some assurity and certainty back into our lives. That's ultimately the theme there. So on the regionals front, it's still as busy as ever. You know, the Mornington Peninsula is booming, it's pumping, and people are wanting to move there because it's just become so easy now to commute from there into the city. And I think as work life changes and people are into the office as restrictions lift, they'll be back in the office 2 or 3 days a week. So they're happy to work, you know, remotely down there as well, which is great. Surf Coast, and that includes Geelong as well. Again, it's going through immense amounts of growth, as with certainly the regional areas north, like Bendigo and Ballarat and areas like that. So they've continued to well and truly weather the storm and draw people in from the city. So all in all, we're really seeing some wonderful momentum continue to grow. Heightened levels of stock well and truly, but we've that absorption rate is certainly high as well. So we've got a rather balanced market down here in Melbourne.
Thanks, Peter. We might go over to Matt, who's in New South Wales. Matt, you might need to unmute yourself. I'm sorry. New South Wales is my hometown. It's gone berserk in Sydney in terms of pricing. Can you give us your insights, Matt?
Absolutely. Firstly, thanks, Tim Lawless. He just gets it right every single time. I've been watching him for 33 years now in my career. Just that report was just spot on. But Sydney, so phenomenal. 33 years. This is the best real estate market I've ever seen. It's probably the most bullish real estate market I've ever seen. The second thing which I've noticed dramatically is people, a bit like what Pete Kakos was saying, they don't want to wait to auction. If they want to buy it, they're prepared to pay overs. I'm noticing, so we've just broken 3 suburb records, and in the most salubrious markets and probably the most highly competitive markets. We just sold a house for 45 million in Wallara, another one for 12 million in Paddington, and another one for over 18 in Bronte. These have just happened in the last 4 weeks. Now, these are suburb records by a mile, and these are probably some of the most hotly contested markets in Sydney. Doesn't matter where you are in Sydney, whether you're in the eastern suburbs, lower North Shore, inner west, every single one of my agents down here at the moment is experiencing strong growth in everything. Auction clearance rates, 90% for our company on Saturday. And a lot of our owners, we're just advising our owners to actually keep going to auction, because it's very hard to pick what a property's worth at the moment. If you sell something prior, you've got to be confident that there aren't 4 or 5 other people who would pay more in a pressure cooker situation. So it's a bit difficult to ascertain that. The regionals, as Pete was saying before, and as Tim Lawless mentioned, I've never seen sales like the Central Coast at the moment. Our Central Coast agents and officers, they're absolutely flying. Southern Highlands flying. They're out that sort of Hunter Valley market, Wollongong. We had our auctions in Wollongong last night, huge results, circa $3 million sales happening down there. Haven't seen this happen before. To be able to break 3 of the longest standing suburb records in 3 of the most hotland, Bondi Beach, Bronte, Paddington, Wallara, they're always sort of a bit like litmus test markets for us in Sydney in terms of if the demand's there, it's usually a strong market in those type of markets, to give you an idea. Same with Mossman and Neutral Bay over on the lower North Shore. There are sort of litmus test markets, and you got some of the a lot of the salubrious markets, a lot of bankers and lawyers, etc., in those markets. And a lot of those people, what they've decided to do, got a couple of phenomena happening in Sydney at the moment. Some people have decided they're going to sell their larger homes, buy an apartment and buy a lifestyle property. So we're seeing that happen a lot now. So some of the larger homes are coming on. People are splitting that money they have made in the growth and buying a lifestyle property, say up in, say, call it Central Coast or Southern Highlands, then buying a large apartment, like a 3-bedroom apartment somewhere around the harbour or so forth. That's something that's happening in Sydney very strongly at the moment. So that's one phenomenon. The other phenomenon that's happening, a lot of our huge results we've been getting are coming from expats. So nobody's mentioned that this morning, but it's a really important thing. Sydney's a beneficiary, and I'm sure Melbourne will be too, no doubt, when the expats, these next 50,000, I think, Tim would probably know the number. There's about 50,000 I saw last time that are still waiting to come back to Australia. And I think Scott Morrison was talking about they're the first ones he's bringing back before he brings anyone else in. Now, they're all going to want to live somewhere, right? So most of those people, as we know, charge back into that sort of Sydney, Melbourne, Brisbane has been traditionally the market. Most of them will probably want to buy as opposed to rent. So if we said 75% of those 50,000 were coming back, we're probably going to have 30,000 more buyers coming to this market in the next 90 days. So if we think it's bullish now, when these people can actually come back in, the third phenomenon we're seeing is we all come out of lockdown pretty well much just 8 to 10 weeks out from Christmas. So there's this huge charge now from everybody. Every conversation our agents are having with everybody is, I want to buy and settle and be in before Christmas. So this window of opportunity, Pete's probably finding this as well. All of a sudden, it's all get in before Christmas now. So you can't find a tradesperson in Sydney for love nor money. Tilers, plumbers, carpenters, everything. There's no one around at the moment. They've all disappeared, and they're all too busy, and they're all telling you, don't call me till February. So that's the other phenomenon, and I think that's also delaying properties coming on. And we're going to see from my agents, and their vendors are driving this, the agents probably won't have a break too much this year. Traditionally, an agent would pull up stumps around mid-December and come back early January, because that's driven by owners not wanting to show anyone through their properties around Christmas time, so forth and so on. The agents are all saying to me they're going to run all the way through this year, have a very small break at Christmas, come back very early in the new year, run all the way through and take their sort of delayed break around Easter. So that's actually quite clever, because it looks like that's the way the market's following, especially with the expats in Sydney coming back and a lot of people wanting to go and look at lifestyle properties. We're probably going to find they're going to be able to cut themselves free to go and look over that Christmas break. So agents quite cleverly are determined that they're going to work all the way through to satisfy that need. That's a helicopter view from me, Tim.
Good to see you still bullish there, Matt. Now, let's just go back to Tim. We've got a question here, and I think it's an interesting one in terms of, I was surprised by investor participation in this market. I know rates are low, but there's a question here in terms of, there's lower yields. So is there a trend with this investor in terms of where they're buying, and has that shifted over the last 12 months or so?
It is surprising, and there is a bit of a shift. So a bit of retrospective, towards the end of last year and into January, investors were only about 22% of mortgage demand. That was a record low. Like, normally you'd expect investors in Australia to be around about a third, if a little bit higher, about 35% of mortgage demand is a 10-year average. And they've really started to pick up through 2021, since about February. So on the August data that's come through, we're seeing investors now about 31% of demand. So still below average, but definitely ratcheting up. Part of that is proportionally that first home buyers are now falling as well. So that gives investors a bit of a leg up. And no doubt lenders are also really looking at investors as their growth strategy. They've got to fill a hole from fewer first home buyers. So investors are stepping up. If you look at the trends in where they're most active, it is a little bit surprising. There is a bit of a change underway, but proportionally, I'm looking at the data now, we're still seeing investors in New South Wales are about 34% of demand. That's the highest of any state. despite the fact that the yields in New South Wales are the lowest of any city, and arguably the buy-in price is much higher. So there is a bit of herd mentality here, I think, in some ways. But the change we're seeing, absolutely, you can see it in Queensland. Investors are now about 32% of mortgage demand in Queensland. Amongst the majors, that's the second highest. So I think we're starting to see investors now looking more positively towards Southeast Queensland. The big surprise for me is that investors are still pretty slim on the ground in WA. Again, on the finance data, WA investment levels are about 21% of mortgage demand, the lowest of any of the states. And in my view, that's probably where the best investment fundamentals are. Sure, there's not quite as much depth in the economy with respect to WA. It looks like that's where the yields are the strongest, it's where rental markets are the strongest, it's where there's probably a bit of longevity for value growth as well. And the buy-in price is amongst the lowest of any of the capitals. So yeah, I'll be looking towards probably SEQ, Perth for some of the best investment fundamentals.
And we're just about out of time, so we'll have one more question from Tim and follow through with one for Geoff. Now, given what we're seeing in the Australian markets, Tim, in terms of property prices, is the trend the same internationally? Given COVID has affected the whole globe and there's been various stages of lockdown, is the trend the same?
Well, amongst the Western nations, absolutely. They've all benefited from the same conditions of massive amounts of stimulus, mortgage rates coming down to virtually record lows across most of the Western nations. So, I mean, New Zealand, our closest counterpart here, was seeing much stronger growth conditions than Australia was, but of course they've recently clamped down much more heavily on lending policy. If you're an investor in New Zealand, you typically need a 40% deposit over there. Look at the US, we've seen housing prices are up a bit more than 20%. The UK, even where there's been really restrictive policies for a big part of last year and this year, we've seen the number of home sales has rocketed higher and very strong growth. But of course, there's been stamp duty concessions there, which have really assisted the market as well. So absolutely, this is very much, I wouldn't call it a global phenomenon, but across westernized nations, they've all done the same thing in terms of a monetary policy response, which has been the catalyst for very strong housing market conditions.
Thanks, Tim. And Geoff, just quickly over to you. The agency obviously is a ASX-listed company. What's the outlook given the CoreLogic data, and how do you reconcile that back to your business?
Yeah, look, thanks, Tim. I mentioned before, we're looking forward to a more, I'll call it, rational market. It has been a little irrational at times. And so we see the makings of that in the increased supply coming through to meet demand. What we are seeing is very strong demand. The banks are telling us at the moment that there's record applications, et cetera, still coming through. So hence my, I guess, sanguine forecast on price growth next year. Nothing wrong with 4 to 6 or Tim's, what was it, 5 to 7, I think. That's still very strong in a low interest rate environment. So we look forward to more supply coming on, more transactions, perhaps conditions being a little easier for first home buyers to enter the market. It's not a great thing to have people becoming despondent. And we, of course, as agents will benefit from any increase in transactions. Against the system, though, we're a relatively new company, only been about 4.5 years. We've only got 1% market share. We're looking to gain market share nationally, and we think we've got a very good business model to drive that. So they're the things that we're looking forward to in the next 6 to 12 to 18 months.
Great. Thanks for your time. Great to hear what's going on in the property market as always. Thanks for your time in terms of our viewers, and we'll see you again next quarter.
Thank you very much.